The mining sector has contracted again. Output shrank 9.6% year-on-year in February. This follows a revised 1.5% drop in January and extends the sector's downturn into a fourth month. The latest reading also represents the steepest decline in over 2 years. The largest negative contributors were platinum group metals, iron ore, gold and coal. On a seasonally adjusted monthly basis, mining output slipped by 4.4%, following a revised flat reading in the prior month. With mining output shrinking in the first 2 months of the year, the sector is likely to weigh on overall real GDP growth in the first quarter. Economic growth and bread and butter issues are likely to trump traditional race politics in shaping South Africa's future political landscape. That's according to a poll by the Institute for Race Relations. The data shows support for the DA stands at just over 30%, while ANC support has come in at 29.7%. It also shows support for the DA among black voters has increased dramatically, rising from 5 to 18%. The IRR says this is as a result of the DA's moves to oppose the VAT hike. The CCMA has given the Passenger Rail Agency of SA 60 days to table a just and fair wage offer to its workforce. That's after a dispute was lodged by the state-owner rail operators' two biggest unions. Untu and Sataw's consolidated wage demands include a 15% across-the-board wage increase. This is well above inflation, which is hovering at around 3%. The unions are also demanding a 3,000 Rand housing subsidy, a standby allowance of 50 Rand an hour, a night shift allowance of 10 Rand an hour, a moratorium on retrenchments, and a medical aid subsidy, with the employer contributing 70%. Kumba Iron Ore is looking for new mining opportunities in the Northern Cape and in the rest of Africa. That's as the firm plans to shore up its dwindling mineral reserves. According to the group's annual report, peak production will taper off by 2035. Besides exploring new mining opportunities, the company also plans to develop alternative technologies to beneficiate low-grade ore and investigate options for downstream beneficiation. SPAR says it's prepared to implement the upcoming VAT rate increase, which comes into effect on the 1st of May. The retailer has put systems and teams in place to ensure the transition to the 15.5% VAT rate is done efficiently. The group has also reviewed and adjusted its pricing strategies and promotional materials. To that end, it will roll out several initiatives aimed at helping customers save money during this transition period. Further afield, LVMH shares sank after the world's largest luxury group posted first quarter revenue that undershot expectations as US shoppers curtailed the purchase of beauty products and cognac. Here's more detail in this report.
Shares in LVMH sank on Tuesday after it posted first quarter revenue that missed expectations. That's as US shoppers cut back on buying beauty products and cognac, while sales in China remained weak. Shares in the world's largest luxury group dropped in early trading. This dragged down shares of rivals such as Kering and Hermes. It came after LVMH reported a 3% decline in Q1 sales. This was well below analyst expectations for 2% growth. It's the first suggestion that luxury companies could face another tough year, following US President Donald Trump's recent tariff announcements, which have sparked fears of a recession. LVMH's finance chief said that while performance of its mass-market retail chain Sephora also weakened, the group's high-end fashion brands such as Louis Vuitton and Dior were still, quote, well-orientated in the US. However, this division posted a 5% fall in sales, and analysts said the improvement in this part of the business at the end of 2024 now seems an anomaly.
And the Trump administration is proceeding with probes into imports of pharmaceuticals and semiconductors as part of a bid to impose tariffs on both sectors on grounds that extensive reliance on foreign production of medicine and chips is a national security threat. Let's take a look for more detail.
Drug makers and chip firms may not escape US tariffs much longer. The two sectors are currently exempt, but Washington is now proceeding with probes into both. setting the stage for more actions on trade. That's according to Federal Register filings. They show that the probes began on April 1st under the so-called Section 232 provision. That gives the administration 270 days to wrap up an investigation. Trump himself indicated the likely outcome.
We don't make our own drugs, our own pharmaceuticals. We don't make our own drugs anymore. The drug companies are in Ireland and they're in lots of other places, China. And all I have to do is impose a tariff. The more, the faster they move in.
Trump has already used the 232 provision to look into imports of copper and lumber. During his first term, he used it as the basis for tariffs on steel and other goods then rolled out in his second term. Last week, he exempted smartphones and some other goods from steep extra levies. But he later said the exemption would be short-lived, just lasting while Washington conducted a probe. Trump also promised to announce chip tariffs this week. Drug makers have lobbied Washington to phase in any new duties, saying they need time to shift manufacturing. Big players in the sector have global production operations and could take years to move output to the US. One analyst told Reuters that tariffs on pharmaceuticals could now be announced in mid-May and predicted they could range up to 25%. Trump's on-off trade measures have roiled financial markets and prompted banks to cut US growth predictions. Tuesday saw shares in Asian automakers surge after Trump hinted they could get some relief from 25% tariffs on the sector. He said that the industry needed time to adapt. Shares in Toyota, Mazda and other big names were up over 4% in afternoon trade.